This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was so great to have Art back on the show. It's always great to get an objective view on the oil markets, but I know that you have some additional opinions on crude. What's on your mind?
Well, Patrick, let's take a look at the November WTI futures chart in order to frame this discussion. Listeners, you'll find our Postgame chart book linked in your Research Roundup email. Now, if you don't have a Research Roundup email, that means you haven't yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, look for the red button that says Looking for the Downloads right above Art Berman's picture. As we look at this chart on page 2, we see, the big sell-off all the way down. Now, remember, this is the November contract. So even though the price of crude oil went all the way down to minus $37, that was isolated only to the May contract that went negative. The later contracts never got down. In this case, below about $24 was the low on the November contract. And it's recovered very briskly since then, right up into June. Art Berman pretty much almost to the day called the flattening out. And of course, the price did still continue to drift a little bit higher, but not at nearly the same precipitous rate that it was recovering through May and June. We had anticipated that there would be some kind of a sell-off or correction. Seems like that was beginning at the end of August, beginning of September, and it looked like, boy, it was much less than we thought. Now it looks to me like we really are headed back down. The correction is probably not over. I'm still targeting the low 30s for the short term in terms of this move. And as far as the longer term, I think at some point you definitely have a huge setup for a massive spike much higher in prices. That happens when economies around the globe get fully reopened, meaning that people feel comfortable traveling on airplanes. Everybody is out and about and spending money. And my prediction is, and this is entirely speculation and conjecture on my part, but I think that this is going to take longer than most people expect before there's a vaccine that meaningfully changes anything. Eventually, we're going to get to the point where people have been cooped up for a couple of years, and they don't care what the price of airfare is. They're going to go out and travel and spend money, and I think there's going to be a very brisk recovery in energy prices at some point. As Art described in this interview, I no longer think that that's necessarily going to happen in Q4 of this year, which was my original view. In fact, I think it's very unlikely that a big recovery in oil prices is coming in Q4. I think it's sometime in 2021, maybe the second half of 2021. At that point, by the end of 2021, I'll be surprised if we haven't touched at least $80 and maybe even $100 on WTI crude oil. But that would be if we get a full recovery of everything's back to normal. I'm not sure we're going to get a full recovery of everything's back to normal. Now, what Art said, the one place I disagree with him slightly, he said, look, maybe you're going to get the end of the crisis, but Art feels like we're at the end of a debt supercycle. I agree with him on that. But wait a minute. If we're at the end of a debt cycle, what that's going to mean is the shale patch is not going to be able to get the money they need to aggressively increase the rig count and increase U.S. production. And that's a setup for oil prices to really just make a moonshot to the upside. At least 80, maybe over $100 a barrel, I think is coming on WTI when you get a full reopening of the economy sometime later. Well, what about between now and then? I think we're headed back down to somewhere between $30 and $33. The big question on my mind is what hits the tape first? Are we going to have the expected fall off on U.S. production that Art predicted? Maybe that still happens in Q4 before we get any really deep, meaningful decrease in demand. In that case, I think it gets us up to new highs, maybe 45, 46, maybe even upwards of $50 on WTI. On the other hand, if we see U.S. production continue to hold steady, but the demand situation continues to weaken as we move into the end of this year and early 2021, then I think potentially you get a sell-off down to $26 again, which was the previous low going back to 2015 or 2016. I think it was early 2016 was when we saw that $26 low. Strong technical level right there. I think it's actually 26.08. So I think there's scope for potentially this sell-off that's begun to continue all the way down to $26. But that's only if U.S. production continues to stay strong and demand continues to weaken. If U.S. production falls off before we get those confirmations of demand weakening, I think there's plenty of room for more upside. So it's hard to really tell which way we're going in the next 6 to 9 months. I think as you get in the 9 to 18-month horizon, there's a pretty strong argument for higher prices. But obviously, the further out you go, the less conviction you can have. And we'll have to revisit those predictions as we get into the middle of 2021. Meanwhile, Patrick, I do want to focus on the green box that you added to this chart. I assume what you're highlighting there is the volume profile in that green box. Well, gee, we got a breakdown below that green box just on today's candle in the chart. From a technical analysis perspective, what does that tell you as the technician in the house?
Right. Well, I mean, it's convenient that that also lines up where that big gap happened to occur on at least this November contract, which also lied around this $40 area. For me, the narrative was like we had this big drop in September and we had a bounce, and the bounces are very natural. But in order for me to already be thinking that a new bull phase was underway, you wanted to see the price action beat something more than just a little Fibonacci bounce on the upside. So far, it was really a 3-4 day rally in early September, and it just rolled right over, and we're back down below there. That becomes now a key overhead resistance level. And right now, just very similar to what you're talking about, the likelihood that we still see a little more weakness coming down into the mid to low 30s on this November contract, and in my mind, is entirely possible. The areas to watch are the Fibonacci zones down in the $32 to $34 area, possible place where we could be heading if this does accelerate on the short term. I remain optimistic or bullish the energy market over the longer term, but it may just mean that going into the elections into like November, December, oil may end up doing a lot of chop here and backfilling a lot of that rally off of the April lows.
I agree, Patrick, and I think there's a lot of uncertainty because if you get the weakening demand from maybe a breakdown in economics and lowering demand expectations because of the contested election and the other things that are going on, yeah, definitely low 30s easy, and maybe in an extreme case, 26. On the other hand, if Art's original prediction about U.S. shale production really falling off a cliff in Q4, if that materializes, and now Art's hedging a little bit, saying maybe at the end of Q4 or even into the beginning of 2021. Well, if that happens at the beginning of Q4, let's say, during the month of October, if we go from 10.7 down to 8.7 million barrels of U.S. production, I think we're back above $50 pretty quickly. So I could see this going either way from here, Patrick, but let's move on to page 3, S&P 500. What do you see in this chart, and what should investors think about what's coming next?
Well, first of all, page 3 is a chart in the past. We're looking at the 2018 Christmas Massacre sell-off. And I wanted to put context on this because when we look at what we've been going through over the last 5 or so trading sessions, is the stock market has been backfilling the initial market correction. And a lot of people have this question, was that it? I mean, could the market just start to rally from here? Is it all over, or is there more selling to come? And what I felt was relevant about the late 2018 market correction, which started in September of 2018, was it started in a similar fashion. It started with an 11% market correction that happened over 18 trading sessions, and then we bounced. And the market bounced and retraced more than half of the prior sell-off, and it lasted for the rally lasted for 6-7 days in a row. But really, what we ended up just seeing was over a month of just chop back and forth, whipping down, whipping back up, and then it ended with some very aggressive selling that ended up making this entire market correction one of those 20+% drops that lasted almost 3 months in total duration. And I feel that this is an interesting roadmap. While the market will never correct the same way twice, it's an interesting roadmap or thought process of what would it look like if the current market correction played out that way. And so when we go to page 4, we can see that this drop that we've gone through since the early September top was that we've gone through 14 trading sessions and 11% correction. And since then, we've been now going on this like 5 days of market rallying off of the low, but we're not even 50% retraced the drop. And so the question I'm asking, is there enough evidence to say that a legitimate short-term bottom is in? And I don't think so. I think the market here is still highly vulnerable that once this reflexive bounce off of that oversold condition finishes, the market is still vulnerable for at least another trip back down to the low. And if the elections add some new additional volatility, which is entirely possible, that trip still down to 3,000 on the S&P is entirely on the table in my mind.
Well, Patrick, as I said in the market wrap at the beginning of the show, if there's a way to figure this out and kind of get an idea of what's coming, it's to figure out the U.S. dollar first. Let's move on to page 5. You're looking at the dollar against the euro. Now, looks like we've got a pretty clear head and shoulders pattern here. What's this tell you?
Right. So let's go back to the title of the whole presentation, which is that, is the reflation trade over? And one of the greatest drivers, or the largest precipitating driver of a reflation narrative, is a bearish dollar. And we typically will see a dollar declining, and the byproduct of that is all the cross currencies are doing very well, and more importantly, all the commodity markets are doing very well, which drives an inflationary impulse and gets all of that start being priced in. And so what's interesting is there's no shortage of technicians out in FinTwit that are observing the head and shoulders or rounding top. They all call it a different thing, but ultimately it's a period where the euro has paused that advance. And really the question that we're asking, was that a legitimate top? Because what's interesting about corrections is often simply a natural zigzag wedge correction in a prior rise can often be deceptively, from a technical perspective, look like a head and shoulders pattern. And we're such at a critical moment, an important crossroad to determining whether or not this dollar move is legitimate. And one of the biggest things for all of our MacroVoice listeners to be watching in the coming week or two is, will the euro fail to beat 118 on the upside? I mean, if we can see the euro beat 118 and get back into that range of where the topping formation was in the 119 range, give or take, then that kind of neutralizes this topping formation. And then we have to really actually table the idea that the dollar sell-off may not be over. At the same time, if we see by early next week that this is rolled right over and we're heading to 116 or lower on the euro, that basically, you can start grabbing a handful of nails to put in the coffin on the euro bull trade. And that, I think, is going to be one of the single biggest things to watch.
Well, Patrick, another aspect of this reflation trade is commodity prices. We've seen a pretty significant rally in a lot of commodities, including copper, going back to, the March lows as the coronavirus crisis was kind of bottoming out. It seems like we've broken the trend line here on page 6 of the chart book. What does that tell you?
Right. And so it's interesting because we were talking about the crude oil chart, and crude oil is the most important commodity to watch from an impact on inflation. But copper is also a really good bellwether you can kind of keep an eye on. And some people are saying that this was influenced by the Chinese holiday. But to me, it's no coincidence that this break is happening in line with when we're seeing the dollar strength and weakness in a lot of other commodities. And so to me, with the fact that the copper is breaking down here, oil's breaking down, it's going to really continues to support the idea that at least at minimum we've paused the reflation trade. And more importantly, the one big thing to ask is that is it actually legitimately over, where for several months we may just be backfilling all of these prior rallies that have been in place since March.
Moving on to page 7, you've got silver as opposed to gold to represent the precious metals complex here in this reflation discussion. Why silver?
Well, I just think that we talk gold so much and we've covered it in the market wrap that I figured we'd just take a look at its little cousin. And what's interesting is that sell-off in silver, which was pretty aggressive on the downside, stalled pretty much right at the 61.8 retracement of its summer rally. And often it brings in buy signals and turns things around. But this is the same sort of storyline on the upside towards $25, the same way the euro is in terms of a move back toward 118. While we certainly have bounced from a very oversold condition, I think as early as next week's show, we're going to start to see whether or not this was just a bounce or whether there was a legitimate short-term trading bottom that was established here. And so I'm watching this as to whether silver can actually put something together north of 25. But the longer we stay just consolidating down below here, there might still be one more trip lower in the commodity.
And to give us a broader perspective on commodities, we've got the Bloomberg Commodity Index on slide number 8. And boy, that really is looking like at the end of August there, like maybe a top and the beginning of a new trend with a series of, lower highs and lower lows.
Well, that's exactly it. And this is the single biggest puzzle piece, like you were saying earlier, was the dollar. What it's going to come down to is, has the dollar established a short-term bottom? And are we going to see a U.S. dollar that strengthens into the elections? I think that commodities will have a very hard time to buck the trend that the dollar establishes. And I think that's going to be the one key thing to watch through all of this. And that's definitely what I'm going to be keeping my eye on. But one of the things I wanted to really show on page 9 was the 30-year break-evens. And so this really shows where the market is anticipating inflation. And obviously, when the dollar peaked, we saw that at the same time that corresponded with where the lows on these inflation expectations came in that early March. And since then, the 30-year break-evens have been an upwards pattern. What's interesting is that we put in that high last month on this, and right now we're trading more or less, or at least attempting to bounce down up to about the 1.78 on these 30-year break-evens. And one of the key things I'm going to be watching is, when do the markets start to price in the commodity correction? Because I think that if the crude oil and copper and all of these other commodities continue the trends that were established this week, then we will start to see this reflect in these break-evens. And I think that's the one thing to keep a very close eye on.
Well, Patrick, thanks for another terrific post-game chart book. Listeners, if you want to get a similar chart book from Patrick every single day instead of just once a week, be sure to check out his service, Big Picture Trading. The information for getting a free trial of that service is on page 10 of your chart book or at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.